Paul Roy here, simplifying finance for you. Today, this is part 3 of Investing in Stocks Simplified. And so here's the deal. This is a stock. It's a stock in Pfizer. And this is also a stock, Coca-Cola. They're just pieces of paper. They're fancy and they have pretty writing on them. And one of them's got like a picture of, a chick enjoying Coca-Cola in the 20s or something. What makes one of them worth more than the other one? And that's what we're going to talk about today. There are two ways that people figure out how much to pay for a given piece of paper. Because if you got a piece of money in your pocket, you know what it's worth because it has the value on it. I open up my wallet and there's some $100 bills in there and there's some $50 bills, and I know that the 50 is only worth half as much as the 100 is, and that one will pretty much just buy me a candy bar. But what is this worth on any given day? There are two methods that people use, and they are called fundamental analysis and technical analysis. Fundamental analysis looks at aspects of the company because these are public companies. So their financials are public. You can see them. You can log onto the internet and you can see what the health of the company is if you understand how to read a balance sheet. And people who understand how to read a balance sheet look at what's on that balance sheet and then they say, okay, Coca-Cola has sold $20 billion of brown fizzy water, so therefore Coca-Cola is probably worth at least $20 or $20 million. And then they divide the amount of stuff that the company sold by the number of shares. So if you have a pizza and your pizza is cut into 8 pieces, then each piece is worth 1/8 of the whole. But if your pizza is cut into 1,000,000 pieces, then each little sliver of pizza is only worth 1/1,000,000th of the whole. And that's the way that stocks are. Some companies have only a few shares of stock. Other companies have millions and millions and millions of shares of stock. A good example of this is Berkshire Hathaway. One share of Berkshire Hathaway, last time I looked, was like $150,000. Whereas one share of, something like Coca-Cola is worth 50 or 60 bucks. Does that mean that Berkshire Hathaway is worth thousands of times more? Not really. It just means that the pizza is cut into fewer slices. So you cannot use the dollar value of the stock to determine how valuable the company is or the worth of the company. You just can't do it because it's comparing apples and oranges. So in fundamental analysis, fundamental analysis looks at the fundamentals of a company. Is it making money? Has it been making money in the past? Has the amount of money that it's been making been growing? That's fundamental analysis. And people look at this and then they assign a value to the stock based on what they're willing to pay. Remember that I said buying a stock only entitles you to the portion of the money that the company gives out in the form of dividends or distributions or whatever. So that is fundamental analysis. A lot of people use it. And you can go deep into fundamental analysis. You can just take courses and courses and courses on it. I'm not going to do that because this is Investing in Stocks Simplified. If fundamental analysis appeals to you, research it. There's a lot of stuff about it. The other way that people decide how valuable a stock is something called technical analysis. Technical analysis doesn't care about the underlying company that is represented by the stock. Technical analysis looks at patterns. If you have a home heating oil company, it is reasonable to assume that they earn more money in winter and less money in summer. Now this is a really simple and really hypothetical example here. So if you were to say buy a home heating oil company in summertime when nobody is using home heating oil, it is reasonable to assume that it's going to be cheaper because it's not making as much money. If you then sell it in the height of winter right after a cold snap, when everybody is buying heating oil, and then there's a hurricane and people are stocking up on heating oil, you're going to end up selling it for more because the company itself is worth more at that moment. So that's the really, really basic of technical analysis. People see patterns in the past and they extrapolate those patterns into the future. They assume that what happened in the past is going to happen in the future, and sometimes it does. And sometimes it doesn't, which is why it's not foolproof. There is pretty much no foolproof way of knowing if the thing that you're going to buy is going to go up or down in value, which is why most people just hold on to it for a long period of time. Day traders are the exception to the rule. Day traders are buying and selling rapidly, and there's a whole science behind that too. And unless you're willing to compete with people who literally spend millions and millions and millions of dollars to perfect their algorithms, you're probably not going to be competitive with them. But if it interests you, go join a day trading firm and leverage all of their experience and their expertise and their capital. So fundamental analysis, technical analysis. You can pick your beast. They both work and or don't work, depending on who you're talking to. The fact is that in general, you are just looking to buy low and sell high. So that's the video for today. And I don't know what I'm going to make a video about for the next part of this series. I guess I'll have to figure it out.